Good morning, ladies and gentlemen. I'm going to keep this one brief and I'm going to give you what I think is the current macro narrative. There is not a lot to learn from the model. Its score is high and therefore you should always prefer equities on any dip to bonds. But without further ado, let's have a look at what I believe bonds are doing and why they are allowing equities a free run to the upside. Let's first of all look at the state of the real rates. I think real rates here are extremely important, and you will remember that a few weeks ago when the ECB cut, Lagarde actually mentioned real rates and that they don't want them to go too high. And since then, we've been basically stuck around the 220 area to the 2 area. I think this is exactly what central banks are trying to do. They're trying to pin real rates around the 2% area in order to keep on squeezing inflation, but without causing a downturn in the economy. That, at the moment, certainly seems to be working, and I don't think that real rates are going to move a million miles away from 2%. If we then look at what term premia are doing, term premia are stuck around zero. They just keep on going slightly higher, slightly lower, but basically they're stuck at zero. And if we have a look at the 5-year forward inflation expectations, we see that they're basically stuck around 240 to 220. Very narrow ranges for all the indicators that would move rates one way or another. To me, the bond market is now stuck because of the expectation that the Fed will cut, but that the cutting cycle will be shallow. After the non-farm payroll and all the weakish data that we got last week, the short end is now pricing in fully what the Fed dot plots are, i.e. one cut starting in September. There might be one cut in December, or it might be postponed till January, but basically 1 or 2 cuts in 2024, and then either 4 or 5 cuts in 2025. And you can see that the predicted prices are right on top of the actual prices. It really doesn't matter whether this is 20 points or 15 points too high or too low. That is just a factor of when you put the cuts, whether they're 3 months forward or 3 months back. But really that to the bond market makes no difference. The 2-year note is now pricing in 100% probability of a cut in September, and then a cutting cycle which basically reflects the Fed's dot plots, i.e. 2 plus 4 or 1 plus 5 really makes no difference to the 2-year note. That is where we are, and we really can't do much better. The very short end was the beneficiary on Friday from the weak-ish NFP, and it should continue to be the beneficiary in terms of reduced volatility to the upside. I think it's very, very unlikely that over the course of the next several weeks, unless CPI is a big miss, that we see the 2-year note above 475. I think we are now stuck in a 455, 475 range for the foreseeable future. It's very unlikely to me that we break this 455 area with any impulsion anytime soon, simply because I just don't think that the Fed wants to accelerate the path of cuts unless unemployment starts rising. All the data that we had last week shows a moderation in growth. It doesn't show any signs whatsoever, and this is important, no signs whatsoever that we are going to go from an expansion which is moderating to any kind of recession, i.e. negative growth. Just because positive numbers go up less fast does not mean that negative numbers will follow. Negative numbers will take a long time to appear if they appear. So at the moment, the soft landing narrative is the predominant one, and rightly so, because the data supports it. I think it's very unlikely that the short end does much better than the Fed's dot plots, and I think the Fed is going to resist any kind of move like we had here at the beginning, at the end of last year and the beginning of this one. I think they are going to try to maintain the market's ranges within their dot plots. As I said, either 2 plus 4 or 1 plus 5 makes no difference to the bond market. Twos are going to basically trade around this 255 area and be stuck very close to it, simply because this is where we are discounting nearly 100%. In fact, we are discounting fully 100% a cut in September. I think July is far too soon unless the unemployment data is unless the CPI data on Thursday and PPI on Friday are big misses. And really, I can't expect a big miss simply because oil price has gone up nearly 10%. And, is it streaking higher? No, it's consolidating at the upper levels, and therefore it's unlikely that the numbers are going to be a big miss. And that tells me that we are stuck in this close range. If we look at fives, you get the same picture. Look at the 200-day moving average. I think that slowly we're going to just trade using the 200-day moving average as some kind of resistance to the upside. And if you look where we are, you will see that every tenure is very close to the 200-day moving average that is slowly rolling over. And that tells me that the lower edges of the Bollinger Bands will be big support, and then we trade back up, and basically we just zigzag throughout the summer until we get one piece of data which goes one way or another. And I'll explain that when we look at the yield curve next and what that means for the yield curve. So here we have 2s, 10s, and basically they have rejected the 49.50 area, and they're now on support around the 32 area. I think that I am probably wrong in thinking that the yield curve is going to steepen anytime soon, simply because the 2s are now at a level where it's unlikely that they can do much better. So why would the yield curve steepen? I think the yield curve can steepen only in two circumstances. One is a resurgence of inflation, where the Fed does not hike, and therefore the bond market at the long end revolts and yields at the long end go up, while yields at the short end do nothing. That is unlikely, simply because, not because the Fed would hike. I don't believe the Fed would hike for a moment, but I think a resurgence of inflation is unlikely because commodity prices are well behaved. And as we saw Friday and from data earlier, wage growth is moderating, i.e. it's not accelerating, it's moderating, and therefore I just can't see where the inflation currently is going to come from. So I would discount that scenario. The other scenario is where you have a fall, a precipitous fall from growth to negative growth, i.e., an indication of recession. I think that is unlikely as well, because you would see some signs from the stock market and there are absolutely none. What does that mean for the yield curve? That probably means that we are stuck around these levels, because we all know that the Fed will start cutting and most probably will maintain a cutting cycle that is, how shall I put it, shallow. I can't see them cutting to below 4%, simply because I just can't see that there's a need for it. I think they are going to try and maintain real rates somewhere around the 2% area. I showed you the real rates chart earlier, and unless and until inflation really starts coming down, I don't think they're going to want to bring real rates below 2%. I know that at the long end they don't decide anything about real rates, but they can certainly influence them via the speed of cuts. I think that it's terribly unlikely that we move out of this range for the time being. I think we probably need a longish period of a couple of months going sideways before we can test this 16 area. To me, this 16 area is going to be absolutely key, and the signal that we are likely to be falling into a recessionary cycle, a certainly predicted one by the bond market. And I just can't see that happening anytime soon. So holding steepeners down here is probably not a great idea. I mean, I will trade around my steepeners and I can, withstand this, this range, because I trade it. But holding steepeners to me here, it seems to be a waste of money. I think we are stuck and we're trading between 47 and 27, i.e. a 20 basis point range. And that is the kind of range that I see in absolutely everything, whether it's 530s or 210s. I just don't see that we are going to move a long way. So this is now 530s. I think that is stuck between minus 30 and 10. We are just not going to be moving much more than those 20 basis points up or down for quite some time, I believe. And then we will see. But the important thing is that the moving averages are beginning, all of them, to turn over and indicate that in the long term, that will be the way to go. It just means to me that for the next month or so, we will have a very stable range, like we did here. So this is from November until, the beginning of the year. We just did nothing. 2 months of doing nothing. Yes, I think that that is far more likely than we start breaking to the downside at the moment, simply because the short end, as I showed you, has discounted 100% of the Fed's dot plots. And to move away from there, we really do need some really change in data that we are getting, i.e. to fall out of the Goldilocks scenario. And I think that that is low odds at the moment. Unsurprisingly, much can be said about the German yield curve and rates in Europe in general. I think the central banks are talking, they're cooperating, they more or less want the same thing. They want to keep real rates at a certain level whereby they keep on squeezing inflation without squeezing the economy too much. I think the Schatz is now stuck as well between this kind of 270 area and the 299 area. And the interesting one is the Bund, which I think has room to come down a bit after the French elections today and therefore next week, but probably less than the French market, which I think at some stage trades back down to 3%, because I think the panic in France is now over. If we just get a cohabitation or a hung parliament, the odds of the new government, whatever it is, being able to go berserk with the fiscal stimulus falls away, and therefore we just get a market which continues to move sideways. And that is basically what I think we are likely to get. If we have a look at something like Italy, Germany, you can see that it's fallen back to the previous levels at a swing of around 146, and it might move 155 to 146. But what that is saying is that we are not getting panics anymore. It's unlikely that we are going to see big moves to the upside in those spreads. If we look at France, Germany, panic over, we should settle somewhere around the 62 area if the election results are normal, as it were. I think that from there the reaction is likely to be lower, because confidence will not have been fully restored until they see whatever the new government does. But it seems to me that we are now in a little bit of a higher range than we were. We were basically 60 to 40 or 45. So now we're going to be 60 to, I don't know, around here, 75. Panic will be over, this gap will be filled, we'll trade the 62, and that is the moment to abandon the French 10-year note. And if we ever look at that, what would that be? That would be somewhere around here, 305 to 310. That will be the area that France becomes not interesting anymore, as it were. One chart which is slightly puzzling me is this one, and it's the 10-year Germany-US. Why is it not able to maintain higher levels? The argument is always the same. The Germans are not issuing that much. Their economy is much weaker. And the US is issuing bundles and bundles. And next week we have 3s, 10s, and 30s to the tune of 108, 109 billion. So this spread is beginning to tell me that this 173 level is going to be very, very important. If we start closing below it, something is going on, and it'll be a signal for the dollar. The dollar is then going to move, I believe, out of the current ranges. At the moment, I don't see why it should happen. I think it's much more likely that we remain in this range and slowly turn this moving average and then break 173. Because to break it would signify that you are getting an acceleration of prices in the US. And that really must come from very, very weak data in the US. I can't see that it's going to come from anything much in Europe, but we will see. I just know that this level, it now becomes extremely important, and a weekly close below there starts really arguing for a move at least to 152, but probably more likely eventually down to these levels, at least around 140, 135, and that is a big move. That would mean that the US is accelerating cuts, or that the market says that the Fed should accelerate cuts. And the only narrative that I can think that where that would happen is one where the data becomes very, very weak indeed. So we shall see, but I will definitely consider a break of 173 very important for the dollar. So let's have a look at the dollar. Nothing really worrying here. As the political situation in France has calmed down, the UK election came and went, the dollar just gave up all the fear that had been built in the previous couple of weeks. It's really nothing to write home about. We are still within the very clearly defined range of 104 to 106, or slightly above 106, that we've been in for months and months. And I think this range holds all the way until we start breaking the 173 level decisively in the differentials. When we do that, I think we will easily trade down to 103. And if we look at a longer term chart, I think 103 is going to be the first support. But after that, if there's a continuation of that break, and we do see those 130, 135, 140 levels that I just talked about, I think it's quite possible that we go and trade all the way down here to around just above 100. I'm not hugely bullish for the dollar. I think that we are in a range still for 2 or 3 weeks, or 2 or 3 months even, and then we will try to break down, because this 106 level just does not seem to be somewhere that it's happy. If we change that to a euro, I think it's very, very unlikely that we start breaking or even testing this 106.60 area again, because that would mean that the differential is around the 190 area again, and I just can't see it going much higher. So to me, the dollar is a buy around the 107 area, and it's a sell anytime that it gets to anywhere near 110. And we are in that range. We are in a 2.5–3% range, and that is all there is to be said about it. That 172 area is going to be my trigger to load up on call spreads in Euro USD. Well, gold likes to make a fool of everyone, and including myself. So it just wouldn't break this retracement level around the 2300, 2310 area, and it's now gone up with bonds. I still don't like it nearly as much as tips, as real rates. I think that from everything I've told you, if the central banks are trying to hold the real rates around the 2% area, then gold cannot make new highs. I just don't see why it would, unless the inflation data become very high and the Fed won't hike. So I just think that that is extremely unlikely, and extremely unlikely things don't happen very often. So I would have thought that if it continues next week and it tries the old highs again around 2450, it's probably worth fading. I just can't see gold making a new leg higher without something big happening in the bond market. And as I've told you, I just can't see anything big happening in the bond market, because we are now discounting 100% of the Fed's dot plots. If we are discounting the Fed dot plots, the only thing that's going to make the bond market move is new data, which is shockingly different from expectations. And I just think that the odds of that are very low indeed. Commodities are in a range. That's all they're doing. They're ranging. Let's enlarge this area so you can see exactly where we are. We are basically trading a very narrow range, and we know where the resistance is, 24.39. The whole of 2023 and the whole of 2024, we've basically been a couple of percent above it and a few percent below it. This is not an acceleration of inflation. We could easily see this squeeze up to 24.39, and that is where I would say thank you very much and goodbye. I just don't see that we are anywhere near a breakout. We would need to maintain 2-3 weeks of breakout above 24.39 for me to be even in the slightest bit worried that commodity prices are going up, and that therefore there is a probability, any kind of probability even, that inflation can accelerate. I just don't see it at the moment. I don't see that the data is going to turn around on a tuppenny bit. It really needs a lot of time for that to happen. So to me, anytime it gets to 24.39, you just sell anything that you have in commodities and you wait for the pullback. Before I show you equity charts, I just want to tell you what I think is happening here. This is SHI, so this is 1 to 3 year bonds. Okay, this is the chart, and we'll go further back because this part here is important. This is the chart without being adjusted for dividends. Let's adjust it for dividends. We are making new all-time highs. This is IEI, so basically let's not adjust it for dividends. So this is 3 to 5 year area. Let's adjust it for dividends. We are beginning to break out of this area and go higher. Now let's do the same for TLT for fun. This is without adjusting for dividends. This is adjusting for dividends, i.e. nobody can see any difference. I'll do it again. Not adjusted for dividends. Adjusted for dividends. Okay. So what do I think is happening? I think a whole load of people, like myself, put money in here. And every month they are getting a nice little dividend. And when they get the dividend, what do? They buy stocks. That's what I have done. And I believe that a whole load of people are doing that on top. So just keep that in the background. But let's have a look at TLT. It's very important that we have this stability in the bond market for equities. While we have this very narrow range, and in 2024, really the effective range has been 89.93. That is a very narrow range that gives huge stability and huge anchoring to what? To the defensive stocks, let's call them. Let's call them the Dow stocks, the ones that are uninteresting. Basically, they're going nowhere. The only thing that is moving is tech shares. That is the only thing that's moving. And that is the only thing that will move until we break out of this range of TLT for one reason or another. If we now look at something like DJI over TLT, so the Dow stocks over TLT, we can see that really there's been very, very little movement in the past 7-8 months. We are very, very slowly trending better. If we have a look at IWM, again, since the beginning of the year, nothing. This is like 1%, 2% different from the beginning of the year. We are really not screaming away in any stock market. And then if we look at ITOT over government, the totality, yes, this is much more accelerated. And then if we naturally have a look at something like SPY TLT, we can see that we are breaking out there as well. It's terribly unlikely to me that we get any kind of weakness in the stock market until TLT moves one way or another for one reason or another. I believe that the indexation of equities that's been going on for the past, well, let's call it almost 2 decades, means that there are very few sellers of equities at any stage. Equity supply is fixed. Good equity supply is certainly fixed. It's actually going down, right, because of all the buybacks. Apple, Google, etc., all the shares that are leading this charge are doing buybacks, so their supply keeps on going down. The supply of TLT keeps on going up because the government is issuing so much. So why would this change? The only reason why it would change is because we go into recession and people can't spend any money. But the data just doesn't show that we are anywhere near that kind of a scenario. And while the current Goldilocks scenario persists, and TLT is in that range that I showed you, and it's fixed in that range because A, the Fed wants to maintain rates at real rates around the 2% area to squeeze inflation out. And also we are not getting any kind of recessionary prints from the economy. Why would TLT move? And if TLT doesn't move out of that range, what do you do with your money? You put it in equities, you put it in the stuff that's leading. And that stuff has less and less supply. Most of the supply is locked up in passive investing, in ETFs which have to own it. And therefore, unless people dump those ETFs and dump the passive strategy, it's very unlikely that the stock markets can have any kind of big correction. Let's have a look at SPX on my clean chart. And really the levels become very, very obvious. While we're above 54.47, there is absolutely no pressure on this market, and the natural way for it will be to go up. I really don't think that even any kind of trade which does not take out 53.72, I don't think that is bearish in the slightest. I think that as long as we hold 53.72, but really 54.46 would be some kind of a yellow, light. 53.72 starts getting, there's something going on. But while we are above those levels, I really can't see any reason not to buy dips and continue buying dips in equities. I've been saying it for months. I just can't see any reason not to. I could show you the daily charts. I could show you the weekly charts. Believe me, we are basically trending, and we're trending above the Bollinger Bands. In my experience, when that happens, the only thing that you can look at as any kind of resistance is the monthly Bollinger level. And as you can see, the monthly Bollinger level is around the 56.35, let's call it 56.50 area, because by the time it gets there, it moves the Bollinger Band slightly higher. So 56.50 to me is the area that either it'll trade and come back. So on a monthly basis, either it goes through it, but then it comes back into it and then goes again. So that is the area where I don't think there's any longer term value, 56.50. Otherwise, in my experience, the monthly Bollinger Bands always hold the key to the upside. And you really do not want to think that just because it's above the daily Bollinger Band or slightly above the weekly Bollinger Band, that it can't go to the monthly Bollinger Band. It can, and it most probably will. To me, above 5650, this market then becomes irrational. And whatever happens, even if it goes 1-2% through it, it'll come back. So that is where I can set my overwrite options, no lower than that. I can set against my long portfolio. I can sell 56.50, 56.75 calls on XPX, short dated when it gets there, and hope to make, I don't know, 0.5%, 1%, something like that. I really will not sell this market before we get up there. What is the equivalent level in NDX? And as you can see, it's actually right up here. It's 20,800, and probably by the time we get there, it's 21,000. So that is the area that you want to be selling, around the 21,000 area, but you're taking profit up there. You're not shorting it, or you're overwriting. We are in a trend for the reasons that I described you. I think there just aren't enough equities, not enough quality equities, and they're being bought back. So don't look to, this is not going to change in the short term. Don't look for levels to short equities. To me, it's absolutely pointless. And just before anyone thinks that this is just a US bubble and a US phenomenon, this is Nikkei, new all-time high close. Where is the level, the equivalent level on the monthly Bollinger? Well, by the time we get there, it'll be 43,000. So you can see that, it's everywhere in these equities. I think that even our friend Europe could start catching up, because you can see what the monthlies are doing here. Let's enlarge that. The Bollinger Bands are moving higher and they're opening up. So we held this 48.50, right? Absolutely could not close below it. Every time that we tried to go below it, it got bought. And now all we've done is a 1, 2, 3, 4, 5 month consolidation, and we could easily start breaking up and going up above 5,200. So it's all these equities. Europe is being held back for obvious reasons, because it's the weakest economy and also it had the most geopolitical worries. But here we go. It's all these equities. It's not just the US. In fact, the US is probably going up the least, because I showed you the Dow, I showed you the Russell. They're doing nothing. If you combine Dow and Russell, they're zero for the year. So 7 months of going sideways. So don't be surprised by equities breakouts. I just can't see that there's any chance of more than normal trading range retracements. I hope I've clarified what I believe and why I believe it, and what I think the consequences of those macro beliefs currently are. I've changed all the levels. I think the yield curve is going to remain roughly stable. I think the odds of us breaking to the downside in yield in here are very, very low for the time being. We would really need some extraordinary data to do that. And therefore, the important thing is going to be the differentials, and the differentials are going to be key here, of 173, because that will give us a direction, a trend direction for the dollar. If that breaks, the dollar can only go down, I believe. So that's going to be interesting. Otherwise, really not a seller of anything in equities until we get up here to the monthly Bollingers and I can probably overwrite some calls against my call portfolios. But you won't catch me going short of equities, just like I haven't been short all year. Not interested. Thank you very much indeed, and tweet to you on Monday.